Hello, everybody, and welcome to the latest edition of CNF Talks, where we interview speakers at some of our forthcoming conferences. Today, Charlie Lytle, Chairman of Corporate Broking at Goldman Sachs, is joining us. Charlie is going to be speaking at the International Capital Markets Summit, which is taking place as part of City Week at the Guildhall, London, on the 20th of May. Charlie, welcome.
Thank you, Morris, and thank you very much for the opportunity to speak then and on this recorded call.
It's our pleasure to have you with us, Charlie. Turning to the first question, to what extent do you think that the slowdown in net equity issuance, not just in the UK, but in other international markets, is due to the growth in private equity as a viable alternative in terms of providing growth capital to technology and other high growth businesses? Is there simply less pressure to go public or less incentive, perhaps?
Yeah, it's a really good question. I think if you look over a 34 or 40-year perspective, you can see different capital providers coming into the market, and private equity is probably the most well known of those. But of course, there are also venture funds as well. And I think young
Yeah.
businesses have opportunities to go to private capital providers in a way that they probably couldn't have done 20 plus
Mm.
years ago. And that both those markets have been growing. Of course, in the last couple of years, through a combination of some of the returns, which were pretty negative in VC land, and also the rising interest rates, it's become a little
Mm.
more challenging for some of those private capital providers. But they're here to stay, and I think they will provide an alternative to the public capital markets for some time.
Mm. I've seen a lot of debate about whether there's a level playing field between the public and the private markets. Do you think that some of the disclosure requirements, particularly say in relation to ESG, are too burdensome for listed companies? And if there isn't a level playing field, what might be done to redress this?
I think this is a huge topic, and I'm certainly of the view that the levels of disclosure have risen very significantly over the last 15 years or so. You know, I was recently sent a report on accounts by a client of mine that ran to 600 pages. Well, nobody's going to be reading those, and the effort,
Mm.
time, and cost to put together a document like that is
Yeah.
enormous and obviously a great burden. What I worry about, and this isn't just confined to the public-private markets discussion, is that the burden that sits on companies and enterprise is rising all the time, often for very good reasons and well-meaning reasons in the first place. But
Yeah.
obviously, the more disclosure and cost that is built in, the less efficient these businesses can be. Trying to deal with your question very specifically, ESG is one area of disclosure that has risen over the last 10, 15 years, but there are others as well as various regulators seek to protect
Mm.
customers or interest groups. And I think we should be looking at these things in a wholesale way. There's definitely
Mm.
an attempt to try and reduce some of this from some regulators. And part of the changes to the listing rules and the
Yeah.
reforms that will come through will obviously help on that. But I think we all collectively need to work on it too. That's on both the buy side and on the investment banking side, to just avoid ourselves um, you know, ending up in a morass of paperwork.
Uh, yeah, there's a real danger of that, isn't there? There's a widespread view in the media that shares on the London market tend to trade at a discount to other markets. Why is this? Do you think that eventually investors will be drawn back on the basis that these shares represent comparatively good value? Or are we going to see more companies change their listing to another venue and or more take private deals?
Well, it's a very interesting question, but it's a question interesting you pose partly in the presumption that this is the case. I'm
Yeah,
indebted
yeah,
actually
yeah.
to my colleague Sharon Bell, who's one of our strategists, who published an excellent note, Europe Chasing the American Dream, earlier this month, and in that she's
Mm.
gone through and addressed a number of these issues. So just to give a couple of facts, the
Yeah.
P in Europe is currently around 13.7 versus 21 in the US. So on face value, the
Mm.
multiples are different. But that's
mm,
actually largely a function of sector growth and
yeah.
risk. And you know what that translates into from a sort of market premium perspective is this is the sort of highest level of value dispersion there's been since the global financial crisis. It's currently running at about a 25% um, versus 10% value difference over the
Mm.
the average period of time. And actually, in the last 4 or 5 weeks, we've seen some reversal of that. And so the numbers
Oh,
I'm
okay.
quoting are really the end of March. Let's not get carried
Mm.
away by 1 month of data. But the two
Yeah,
largest IPOs in the world are taking place in Europe at the moment, Puig and CVC. There has been a significant shift. I would say there is a very substantial shift in investor sentiment. I think we're seeing a number of investors, particularly in North America, looking at Europe at the first time in a way that certainly I haven't seen in the last couple of years.
mm,
It's all quite nascent, so we shouldn't get overexcited. But
no,
Japan was neglected for 20 years, and it's become one of the hottest markets in the last 12 months. So
mm,
I think we may be close to an inflection point in terms of relative valuation. Let's see
yeah,
how the future plays out, and I think it is difficult to break the umbilical cord that has existed between high performing US markets and the rest of the world over the last few years, and that we tend to reinforce our own behavior. But I think
yeah, yeah.
that's something that is worth digging into. And just to take the famous Magnificent Seven, Tesla's down 40%
Mm,
this year. That's quite a big
mm,
fall. Nvidia was down, over 200 billion in one day last week. Things can change quite dramatically, and um, I'm not calling time on the US markets, but I certainly think that there's a recognition of the value that exists in Europe at the moment, which we're seeing a number of investors look to
mm,
participate in.
yeah, because there are so many very good opportunities, aren't there, in Europe at the present time. Looking again at technology companies, though, I've chatted to a number of founders of tech companies who are considering their options as to where to list. And the two issues that they really care about are valuations, i.e., where can they achieve the highest valuation for their business when they list, and remuneration. And this is that the latter isn't really something that features so much in the public discourse on this. But how much of an issue do you think that is when founders compare a listing in, say, London versus New York?
Well, I think ironically, actually, when we've looked at the detail on this, the valuation difference in technology is actually the smallest of all the
Yeah, yeah.
sectors across Europe versus the US. So actually, tech companies in Europe can trade at the same or higher valuations than US peers. The big
Mm,
difference
mm,
is that the whole investing infrastructure and capital deployed to tech investing is far smaller here for obvious reasons.
yeah.
When you think of the multiple trillions of value that sit in American tech, US tech,
Yeah.
versus those in Europe and elsewhere in the world, there's clearly a far deeper system that's investing in technology
Mm,
companies. And I think the thing that is attractive, therefore, to management teams is that when they go to a particular market, they get a better hearing and a apparently deeper understanding of their businesses than they might elsewhere. And of course,
mm, mm,
that becomes self-reinforcing. We've seen that in healthcare, and we've
yeah.
seen it in tech. Go back 15
Mm,
years, London was the capital of resources, and people
mm,
came to London. They spent time with experts in mining, oil and gas, and other sectors, and
yeah.
it just turned out that was not a sector that had the same growth characteristics and opportunities
Mm,
as some of the others. So I think it's if you try and answer the question narrowly, it's a bit of a myth, but I don't think we
mm,
can dismiss the fact that there's just a far greater basis of investing in tech and an understanding of that
yeah.
in the US.
Yeah.
As to remuneration, um, I think there has been an effort here to try and address that. It goes back a little
Mm,
bit to the underlying capital providers, in other words, the pension funds,
yeah.
foundations, maybe sovereigns. What do they all want? But the irony, which is not, I'm sure, lost on you, Morris, is that the same underlying capital providers can support high remuneration in certain markets, um,
Mm,
because that is the norm of that market. And in
Yeah.
Europe at the moment, I think we will continue to see um, lower overall remuneration, partly for
Mm.
societal pressures. But there are enough examples, and we'll see this coming through over the AGM season with some quite high-profile schemes being voted through. Most recently, the AstraZeneca one,
Yeah. Yeah.
where
Yeah.
you will see very significant shifts up in potential pay for performance, and so I think that's something that can be addressed. I would say things like split voting capital are important also to tech founders, and of course the FCA is looking to
Mm.
address that in their reforms. But
Yeah. Yeah.
there are still points of difference, and they're important to
Mm.
individual founders.
Mm. So hopefully that's shifting. Finally, in the interest of time, Johnny, there are many initiatives underway to restore London's equity capital markets, including the launch of Pisces, the UK's crossover public-private market. Do you think the Pisces will develop a pipeline of companies that go on to list in London? And more generally, what measure or measures do you think will help move the dial for London?
I think Pisces is really exciting. I think the London Stock Exchange has to be congratulated on a number of the
Mm.
initiatives that they've sought to champion over the course of the last 18 months. Of course, at this
Yeah.
stage, it's unproven, and it will need scale and critical mass to sort of to create momentum for it. To us, there is a huge potential appetite by sponsor-owned businesses to eventually come to market. And
Mm.
at the moment, we're in the middle of the IPO of CVC. By the time of the
Yeah.
conference, obviously that deal will be complete. Um, but I think there is a there is a question for a number of owners of private companies, which is, what is the eventual end game? And I think things like continuation
Mm.
funds can help very successful private companies stay private for longer. But how many private companies are worth more than 25 billion? That's a round
Mm.
number. How many worth more
Yeah.
than 100 billion? And
Mm.
there comes a point where actually even those assets that private equity would like to own forever and ever
Yeah.
need to find another market. And if this is a way
Mm.
to help bridge that journey, then that's, I think, to advantage for
Mm.
public market participants. And I think that there will be more migration from private to public than probably feels today like there will be over the next few years, because I think some of those valuation differentials that we talked about earlier will close.
Mm.
And I think
Mm.
fundamentally, private equity needs to be returning cash to its underlying capital providers. And
Mm.
you can't do
Yeah.
that by continuing to own forever and ever, even if you can release capital on the way through.
Mm. And there's a huge amount of money tied up, isn't there, where the private equity firms are seeking to exit. So, yeah, and I think that's undoubtedly true. And Charlie, thank you very much for sharing those thoughts. For our viewers, if they'd like to hear more on this issue and related issues, please do attend in person the International Capital Market Summit, which, as I mentioned at the start, is taking place as part of City Week at the Guildhall, London, on the 20th of May. Further details available on www.cityweekuk.com. So just remains for me to say thank you very much, Charlie, for joining us today.
Thank you, Morris. Great to see you, and look forward to the 20th of May.
Absolutely. Thank you.